Time to get down to the brass tacks. My name is Mel Sams, and I'm the Managing Associate of Sams CPA located in Dunedin, Florida. And today I'm going to talk to you about the business provisions of the new tax law. As I've said before, with great change comes great opportunity. And you will see as we get into some of the detail here that businesses in the United States are going to have some major opportunities in upcoming years. The first thing that I would like to cover are the expanded cost recovery provisions, otherwise known as depreciation. We all know what depreciation is. We've all heard what that is. And a lot of small businesses take advantage of Section 179 depreciation and bonus depreciation each year when they purchase new equipment as an immediate tax write-off in their business. Well, the good news here is Section 179 has been expanded. You may now deduct up to $1 million with a phase out at $2.5 million. The key is that equipment or asset must be in service in your business by 12/31/18 in order to take advantage of this for the 2018 year. It should also be noted that in the new law, the provisions on depreciation go into effect September of 2017. So as you're filing your 2017 tax returns, keep that in mind because there may be some advantages for this past year that we can still take now and then in years in the future. The next opportunity that I would like to cover with you is that of interest expense. Now, under the new law, interest expense is now limited to 30% of the taxable income of a business. That which is not deducted will carry forward to the next year, but that's something to keep in mind when planning out such things as, do I buy an asset outright? Do I finance it? Do I take on debt to grow my business? Very important that you consider these new limitations because they could have unintended consequences if you're not prepared for them. Now, those of you in real estate may be saying right now, well, what are we going to do because we have these mortgages and we have these other things? Well, the good news is that there is a special break for people in a real estate trader business. Now, what is a real estate trader business? It's too much for me to go into right now, so I suggest you talk to your CPA about that. But in a nutshell, the interest expense for real estate trades or businesses is still fully deductible provided that you make an election. Now, that election will also preclude you from taking advantage of the expanded depreciation rules, something to take into careful consideration when working with real estate trades or businesses. So talk to a CPA about that. They'll be able to help you. The third and final item that we're going to cover is the Section 199A deduction. This is the granddaddy of them all. This is the crux of the new tax legislation. This is the item that is going to give small businesses in the United States a tremendous break. But now the fun part begins because we first have to determine what type of business you are. Are you a service business? Do you make something? Are you a real estate business? Lots of considerations to be made. Ultimately, the Section 199A deduction will allow 20% of the taxable income of certain businesses to be deducted at the shareholder or partner or sole proprietor level. Now again, it's too much to unpackage right now and go through line by line, but I suggest you talk to a CPA about this. They will be able to walk you through this calculation and make sure that you're poised to take advantage of it in 2018. If you have any questions, comments, or suggestions for future podcasts, please let us know. We would really like to hear your feedback, and our contact information will be on screen at the end of the broadcast.